Do we agree with Michael Saylor that ultimately this category, Bitcoin and other crypto assets, could be bigger than SPY? Yes, we do. Absolutely, we do. And Bitcoin alone is going to be the biggest part of the entire crypto asset ecosystem. Our expectation out in 2030 that it will be a $20 trillion, it will be worth $20 trillion. Now, how much will ETFs get of that $20 trillion? I don't know, but that already right there is, if you think about it, I mean, it runs circles around SPY, number one, and I believe all of public equities globally, no matter what wrapper they're in, are valued right now at roughly $120 trillion. So when I say 20 trillion by 2030, that's a very big category. All of the ETFs out there right now hold about 3.9%, roughly 4% as of today, of all the Bitcoin outstanding. Now, the really interesting thing about that is if you look at on-chain analytics, which our analyst David Puel does for us, you'll see that long-term holders account for, I believe, 15 million of the Bitcoin outstanding, roughly 15 million. Total outstanding right now is 19.5 million. And the total that will ever be outstanding is 21 million. Those long-term holders are not selling. That's what's going on with the price right now. And the flows into the ETFs which have taken the friction out of buying Bitcoin and which can be used as collateral for loans, whereas Bitcoin itself cannot, suggest to us that, that added 1.5 million to go in Bitcoin is going to have to cover a lot of investors, institutions, and so forth. In other words, the price will have to go high enough to wrest the supply, some of the supply, out of long-term holder hands. And just to clarify, long-term holders, and again, you can track this on chain, they have not moved their Bitcoin from their wallets in at least 155 days. And when that occurs, the odds that they will move their Bitcoin go down dramatically unless the price spikes dramatically.
So those are the demand dynamics at the moment. And add to that the expected halving event this year. How is the price impact of this year's halving perhaps going to be different this time around because of that landscape that you've just explained?
Yes, so the halving, so we'll go from roughly 1.9% growth in Bitcoin supply per year down to 0.9%. So we will drop below 1% for the first time. And if you look at the long-term history of gold, very long-term, what you'll find is the average supply growth has been roughly 1%. So now Bitcoin supply growth is dropping below the supply growth of gold. That is a milestone, I would say. And the other difference here is when the gold price spikes, there's usually a mining response and the supply spikes with it. That cannot happen with Bitcoin. So it's quite a different dynamic. So the halving is that milestone. And if you look historically after halvings, it's usually been very good for the Bitcoin price. Now, it doesn't happen right away. I don't know why it doesn't happen right away, but it doesn't. Now that the market's becoming more efficient with ETFs, it might, because think about how many people even know about the halving this time around when they didn't even know what Bitcoin was 4 years ago. They didn't know what it truly was. And if I can just throw one in terms of how we try and describe what this monetary revolution is, And each one of these words is important. The first, global, that's critical. Private, no government oversight. Digital, decentralized, rules-based monetary system in history. It is what my mentor, and many people know Art Laffer for his Laffer curve and fiscal policy and so forth. He's a monetary scholar as well. And he said, I have been waiting for this for 50 years, ever since they closed the gold window here in the United States in 1971. I think something very important happened last year. In March of 23, regional bank crisis here in the United States. Regional banks imploded, some went bankrupt, and Bitcoin exploded. It went from 19,000 to more than 40,000. What did that demonstrate? That demonstrated that Bitcoin does not have counterparty risk like banks do. And so it became a risk-off asset. Before, we had just thought of it as a risk-on asset. When liquidity is flowing, Bitcoin will be one of the prime beneficiaries. But this idea that it is also a risk asset, and as we hope we've shown in our own new asset class paper, white paper, its correlation with other assets is so low that institutions have a fiduciary responsibility from an asset allocation point of view to at least look at it. And if they want to dismiss it, fine. Vanguard did. But what we think that Vanguard is doing is, well, one of two things. Vanguard has never invested in commodities, so it's just treating this like a commodity. For the most part, it hasn't. But we think it's a new asset class, and Vanguard will be depriving its clients of access to a new asset class, which, if there continues to be low correlation of returns, what will happen is those using it will see increased returns per unit of risk, and they will outcompete the Vanguard advisors. So, I think there will become, even for the Vanguard ecosystem, a demand pull.
If we can just forget Vanguard for a second, discount them, because as you say, there seems to be many other demand drivers for the price in front of us. So if you had that bull case for more than 1 million USD Bitcoin, has your forecast timeline to reach that price now shortened?
Yes, that target, what we evolved in, it was before the SEC gave us the green light. And I think that was a major milestone, and it has pulled forward the timeline. One thing I will say, right now, no wirehouse, so whether we're talking about Morgan Stanley or Merrill Lynch, B of A, or UBS or Wells Fargo, no platform has approved Bitcoin yet. So all of this price action has happened before they approve it. And so, we haven't even begun. The incremental price that we assume for institutions actually has more than doubled. So, I don't want to give out any particular prices, but because we don't know how quickly the more independent registered investment advisors in the United States, those platforms are saying, give us 3 months to do our due diligence. The others are saying we need at least 6 months. So, I would put those in the institutional bucket as well.